Good evening all. I'm Devang Dave from this HDFC Securities. Today we have this webinar, since this global theme is catching up in India, many brokers have tied up, with global funds, or, the overall US markets, Asian markets, even mutual funds have been launching, this global themes and all. So today, we have this webinar with Access Alert, and we have Ashwin Patni, from Access Alert. Ashwin Patni is the head products and alternatives at Axis. He has joined Axis in 2010, so decades experience with Axis. Before that, he's been in the industry with HDFC, AMC, and he's been with Standard Bank also as a product manager. So, without wasting much time, over to you, Ashwin.
Great. Thanks, Devang, and hello and good evening, everyone. It's a pleasure to be here talking about a product and an idea that is we at Access Mutual Fund are really passionate about, because we think that this product and this idea will transform the investment landscape in India over the next few years. Basically, what we are talking about is investing in global equity markets. While of course, global markets have always been around, Indian markets have been around. In mutual funds, we've had some products also in the past, but the moment for global investing really seems to have fallen in place, and all the blocks have fallen in place, I feel, really in the last 2 to 3 years. If I were to take a step back, what's happened in India in the last 20-30 years, we've seen a big revolution as far as equity investing is concerned. The economy liberalized in the 1990s. Then we had a massive boom from an economic perspective, growth opportunities created, allowed a lot of companies to really participate in the overall boom, and we had a number of companies delivering secular long-term compounding in this context. So there has been a massive 25-30 year sort of compounding that we have seen in the Indian stock market. Indian investors woke up to this over a period of time till in the early 90s. Mutual funds were seen as something that was very risky, and people did not appreciate the compounding power of investing into equities. Over the years, as people have seen firsthand the whole experience, and also as their understanding, awareness has gotten better, more and more people have been very happy to allocate long term, either through systematic investments like SIPs or through regular allocations, through lump sum, various methods, but people have been happy to allocate to Indian equities, such that we are today at a situation where, for most investors today who are actively looking at deploying their surplus, mutual funds is one of the sort of core exposure that they do consider. And within that, equity mutual fund is something that is considered as something which is a great long-term allocation. So we've come a long way, I think, especially in the last 15 to 20 years. And I think that the same transformation is something that we will see also in global, because for any investor, there is always the element of familiarity that you turn to first. So for investors, when when you have to take your first steps towards investing, obviously the first place you look at is the home market, especially in the context of the Indian investor, because the Indian market is doing so well, the opportunities are so large. But over a period of time, what you realize is that as an investor, as you get comfortable with taking equity exposure, what you realize is that as an investor, you don't want to miss out on opportunities wherever they are. It's quite it's a loss to you as an investor, or to us as an investor, if we only allocate money in a segment of the market and ignore some other segment of the market. So just like that, global investing also, it's about broadening our investment horizon, our investment universe. today in India you have some excellent companies and the growth potential is there. But India, one of the statistics I will say is that India is only 3% of the global, stock market capitalization. So the remaining markets, and some of these markets are very, very large. Just to take some 2 or 3 examples, Chinese market will be 3 to 4 times India's size. If you also add Hong Kong, probably 4 or 5 times India's size. Some of the big markets in Europe and the UK are again much larger than the Indian market as well. And of course, the biggest of them all is the US, which is perhaps maybe 10 times or more bigger than what the Indian markets are like. Another way to look at the size differential is that if you just look at the top 2 or 3 stocks on the US stock markets, which is say an Apple, Microsoft, or a Google, which is called Alphabet, the just 2 or 3 stocks put together would be bigger than the size of the entire Indian stock market. So that's the large, massive market or the opportunity which is out there, which is beyond the Indian border. And of course, Indian markets are, as I said earlier, will do well, but there is a lot of opportunity beyond our borders if we open our eyes and if we broaden the universe, which allows us to tap into. So that's the theme for today. That's what we want to talk about, and we have brought for you in Access Mutual Fund, a fund that allows you to really capture the best of the global ideas into one simple fund, which you can access, through the local rupee mutual fund route. So you don't have to go anywhere. It's not very complicated. A normal rupee mutual fund, just like any other fund which you use for investing into, say, local equities or fixed income or gold. Just like that, you can use a local rupee fund to access the best of the global ideas into some fund. How does this structure work? What we have brought is a fund of fund structure. What the meaning of a fund of fund is that the fund in India that Axis launches, that fund is Axis Global Equity Alpha Fund of Fund. So investors who want to participate in this opportunity, they will invest into this fund of Axis. The fund will declare a daily NAV in rupees, just like any other mutual fund does currently. The AUM that is collected by this fund is then remitted abroad and converted into currency, say US dollar, and remitted abroad, and that money is used to invest into a global fund that is run by a company called Schroders in Europe. Schroders, incidentally, just by way of introduction, is a very, very large and successful fund manager which is based out of UK, London in the UK. Schroders, incidentally, is also a 25% shareholder in Axis Asset Management and has been indeed one of our shareholder for the last 7 or 8 years. Schroders is a very successful, old, large fund management franchise, and they have very strong capability as far as managing global equities is concerned. So they have this mutual fund that, as I mentioned, which is run out of Europe, which is based out of Europe and run out of their fund management team in London. And what we will do in Axis is the money that we raise here will be used to buy units of that fund. That fund ultimately invests that money into the best global ideas worldwide. It could be stocks based out of the US, UK, Europe, China, Japan, wherever. Therefore, the investors sitting in India in the comfort of their homes can simply invest into this fund and get access to the best of these opportunities. Why is global investing something that is so important? I mentioned that India is a small part, but that doesn't tell you the full story. You also have to keep in mind that Indian stock markets, there are specific type of companies that are listed in India, and obviously we have big companies in specific sectors like financials and consumers and IT and pharma, but we don't have many of the sectors and themes that are big in the global context. A simple and very easy to understand example is the internet oriented companies, which is social media or e-commerce or the entire internet oriented companies that are becoming very, very large part of the the earnings growth and the earnings story as far as global equities is concerned. So these companies which are really large, successful, growing very fast. There's just one example, but very easy to understand example. Why? Because a lot of us are exposed to these companies, and intuitively we can understand the value that these companies are bringing and why they are growing so fast and what they are really able to deliver as far as transforming our day-to-day consumption basket is concerned. And yet, as while we see these companies as consumers in our daily lives, when it comes to wearing the investor hat, we are not able to participate in this opportunity for the simple reason that in the Indian market, this theme as a whole is not really present. It's not we don't really have large internet e-commerce kind of companies listed on the local stock market. There are maybe one or two of few, but not nothing which is very meaningful as far as the investment basket is concerned. So uh, uh, that is an easy way to appreciate what the minute you allocate a part of your money beyond India, what it is able to do, which is it is able to capture some of these additional opportunities which are out there. It doesn't only have to be some of these new opportunities, even traditional old school successful businesses, some of the consumer businesses, industrial businesses, healthcare businesses which are operating at a global level could be very successful, could be growing really well. And again, it makes sense as an investor to be able to participate in some of successful and fast growing businesses worldwide. So here are the two or three big benefits of why investors should look at global investing. The first point that I would highlight is the point that I made just now, which is that investors when they invest abroad, they are able to broaden their investment universe and participate in opportunities that they otherwise would have not participated in. The second point is why global investing helps an investor is that people are able to diversify their portfolio. So this is more about risk management and portfolio management. So as an investor, when you're investing your buckets, so suppose you have 100 rupees to invest, and you decide, sorry, suppose you have 100 rupees to allocate into equities, and in the current environment, what is happening is almost the entire 100% out of that is likely that you have invested in the local equity markets, whether it is through mutual fund, stocks, whatever. Um, if something happens to the Indian markets, ups and downs, etc., then this entire portfolio is likely to get impacted. Uh, so what can you do if part of this 100 rupees you actually allocate to global equities? Then different markets in the world work in a slightly different way. So you are able to diversify and bring down the overall risk of your portfolio into from just one market, which is the Indian market. Let me explain this through one or two examples. For example, if you look at the context of earlier this year, we all know the kind of massive sort of COVID challenges that we faced as a world and as a country in India, and what that led to from a markets perspective, which was a massive crash in the markets in the month of March. Now, if you step back, of course, Indian markets fell massively, but if you step back and look at the global picture, there were markets out there, which is like China, which didn't really fall that much in the month of March, even though China was affected by COVID. Even on the way back, after April, when markets started reviving, many other markets did fall, including some of the big US and Western markets, but China didn't fall. And when the markets turned around and they started rallying back in April, May onwards, again we saw that some markets were able to bounce back much faster. Example like American US stock market, which was able to bounce back much faster. And indeed, they are at their new all-time highs and much higher than even the Jan-Feb levels. Whereas the Indian market, while it rebounded, is yet to sort of come back to the levels that it was trading before COVID hit us. So different markets react differently. Why should this be? Because the macro situation, the environment in each country could be working a little differently. The sentiment, the kind of investor base could be different. The flow of fund situation could be different. There could be a host of reasons. And what happened this year is just an example. I'm not saying that we are good or bad, but it is something that is part and parcel of equity markets worldwide. There are many years when India does well and many of the global markets don't do well. There are other years when India may have done well, but other markets may have done even better than India. Or there are years when India has not done well. So as prudent investors, as someone who's trying to allocate for the long term, trying to do the best thing as far as risk and return of our portfolio is concerned, uh, trying to broaden the opportunity set to allocate into other markets, what that does is that it allows us to de-risk it or bring down some of the risk of being only present in one market, which is the Indian market. What we have seen is that even a small global allocation, as I go back to my example, suppose there were 100 rupees that you have to allocate to the equity markets. For most of us today, that entire 100 basket could be into the Indian market. Now, out of 100, suppose you start allocating partly to global equities, 2%, 3%, 5%, 10%. So the question we get a lot is, what is the fair number that they should allocate? Should it be 5%? Should it be 10, 20%? Should it be even higher? And the answer is that it doesn't matter, even if you start small, even if you put 2% or 5% of the portfolio. What we have seen is that the benefits of diversification starts kicking in, even if you take small steps. So that is what we will encourage investors to look at. Start tracking global products, start looking at taking allocations even in a small way. And over time, as you get the comfort, confidence, you can start making more meaningful allocations as well. I go back to the way we have seen Indian equity mutual funds transform. It has taken 15, 20 years for investors to get that comfort, confidence of allocating to the markets on a regular basis, and seeing how that experience has helped them, and to take it up from there. So we can expect to see the same thing with global as well, where people may take some time, make a smaller allocation, take some time, and get more and more comfortable till they increase the such that they can increase the allocations slowly over a period of time. I would also urge everyone that we are not at all, and this is a misconception which sometimes gets created when we talk about global investing, is that people feel that the reason we are talking about this is that we feel that global markets will do much better than India in the next, say, few quarters, next 6 months or 12 months or something like that. So I will again reiterate, it is not about whether global markets will do better or Indian markets will do better. The simple answer is nobody really knows in any case how equity markets will do in the short term. The idea really here is that markets will do differently. And if different markets do differently, and within each market you have some great businesses which you can own as investors, then both of these put together means that you can create a portfolio which allows you to bet the best businesses and yet enjoy diversification benefits, which brings down the risk or the overall portfolio. And that's what global investing is all about. Coming to the product itself, as I mentioned to you, the name of the fund that we have is Access Global Equity Alpha Fund of Fund. Also already mentioned that it is a fund of fund that will invest into a fund of Schroders, which is Schroders Global Equity Alpha. What is the uniqueness of this fund that we have brought to, which is our first real global feeder that we have brought here? The uniqueness is the proposition that Schroders has when they're managing this strategy. Essentially, they are running it as a global best ideas portfolio. What does that mean? That means that they scout a universe of more than 2,500 stocks all over the world. And from that, whatever the best 45, 50, 55 stocks that they find, they allocate into those stocks for this fund. So essentially, as an investor in India, you get the benefit of the best of global ideas. Some that a fund manager, which is an informed fund manager, which is well equipped to take global views, based out of London, is doing all that effort, and you are able to access that entire expertise, where they have looked at stocks from all over the world and really selected the best 45, 50 stocks for the portfolio. So that is the uniqueness of this fund. It is also, as I mentioned, as the name suggests, it is a global fund. So the global fund means that it is not restricted itself to only one market, either US or Europe or China. It is opening itself up to opportunities wherever they are. In any of the big countries, any of the markets, wherever the companies are listed, you are able to evaluate them, and if it makes sense for the portfolio, they are able to allocate them. So that's the unique feature of this fund. I will also highlight some of the nuances when you're allocating, because this is something that, while as a rupee NAV local mutual fund, it works very similar to normal funds, but there are a few things to keep in mind. The first is that the structure, which is from a fund of fund perspective, when you allocate, the tax status is that which is akin to a debt mutual fund. So even while you're investing in global equity products, because of the nuances of the way tax rules work, in terms of its categorization, it will get categorized as a debt fund from a taxation perspective, which means that to get benefit of long-term capital gains, you have to hold this product for 3 years or longer. Likewise, the redemption cycle for this fund of fund will be a bit longer than the local funds. Local funds, typically, especially equity funds, when you look at, typically the redemption money comes back within T+3. If you put a redemption in T, then within T+3 days, you get your money back into your account. Because these are a global product, and the redemption will have to be processed by us back to back with the global fund, the cycle gets a little extended. And essentially what we are talking about is a T+5 cycle, where if you put a redemption on T, you will get your money in T+5 days. So these are some of the nuances. These are sort of minor points, frankly, but the main point really is that the structure is an Indian mutual fund structure with a daily NAV and an open-ended structure. It works exactly like any other fund, and it allows you to participate into the best of the global opportunities. Um, so this is a quick overview of that product. I'll pause here. Sorry, before I pause, in terms of one other thing I will say is that we get a lot of questions also in terms of what should be the horizon and what should be the way in which people should invest into these funds. And I will again reiterate that this is ultimately an equity product. So think of this as a strategic long-term product in your portfolio when you're making allocations. Don't try to time it. It's not about the next 6 or 12 months, but more about the long-term opportunity. That's the first point. The other point is also that equity markets are by their very nature, volatile. They go through ups and downs. This is true of India. This is true of the global markets as well. So therefore, it will be prudent to not take again too much of a timing risk. Make sure that you make regular allocations, SIPs, regular staggered lump sums, whichever works for you, and make sure that you take a reasonable long-term horizon while allocating this money. So that's the quick summary of global investing. I'll pause here, and if there are any questions, then we can take them.
Thanks, Ashwin. Thanks for taking us through this theme, and what the investors will get in this. It's an exposure to global ideas all over the markets. That is restricted to anyone. So the US, Europe, Asia, and what businesses they can. Quickly, we'll have to go to questions and answers because there are some 15 questions which are. The first question coming up from Mr. AR. What are the components of this fund? Which companies or communities are held in this fund?
I'm sorry, your voice was not clear. Can you just repeat that question?
What are the components of this fund? Which companies or commodities are held in this fund?
So it's ultimately an equity fund. So basically the components of the fund. So there are two stages. The first stage is the Axis fund is essentially a fund of funds. So the Axis fund holds unit of another global mutual fund. The global mutual fund in turn owns equity shares in leading global companies worldwide, about 45 to 50 companies. The Schroders owns equity shares in these companies. Some of the companies which are there in the portfolio here includes names like Microsoft, names like Amazon, names like Adidas, Nestle. So basically global companies which are listed in the global markets, 45 to 50 companies out of that. That's what the Schroder fund owns, and Axis's fund of fund will invest in that Schroder fund.
Second question coming up from Mr. AR is, would currency exchange rates risk eat away gains? In a way, he's asking, would you hedge and against currencies?
Yeah. So in a way, actually, currency may actually add to the gains rather than eating away gains. So because it's an open-ended fund, the horizon is quite open-ended as well. So therefore, there is no point really in hedging. And in fact, one of the reasons why you want to allocate beyond India is to also de-risk yourselves from the Indian risk, which can include the currency risk. So when you invest abroad, keep in mind that for many of us who've been tracking the dollar rupee rate, rupee has been steadily sort of depreciating over the last 20, 30 years, in fact, even longer. And that is not an accident, it is happening because of the certain fundamentals of the Indian economy. So to the extent that rupee has a bias to depreciate a little bit every year or every few years, uh, rupee depreciating because your assets are going to be lying in a foreign fund, say based in, say, denominated in, say, US dollars. To that extent, that will actually add to your returns in case the currency depreciates. But of course, this is ultimately an equity product. You should not invest for trying to get currency benefits. That can only be an offshoot. But to the extent that rupee has a tendency to weaken or depreciate longer term, this can provide a useful protection for investors.
And the next question coming up is from Mr. Vasudeva. He's asking, the global market share has zoomed, even though GDPs are down due to COVID-19. So is it safe now to invest in global markets, or one should stick to Indian markets?
So I think these are part and parcel of equity investing. Markets go through boom cycles. We've seen it time and time again. In these things, the fact that global markets have rallied significantly in the last few months post May. It's also true that even Indian markets have rallied a lot. While of course, as I mentioned in my opening remarks, they remain a little below than Feb highs. But the reality is that even we have seen a massive rally in Indian markets. Well, so as part of one of the big challenges of trading equities, which is you have to be prepared for ups and downs in the market. What I would recommend is don't try to time the market. Most investors, this will be a first time global, so some small lump sum allocation will help to kickstart the whole journey. And then over a period of time, you can make regular investments so that you don't get hit by the volatility in the market in case of correction.
The next question coming up is from Vishal. He's asking how much exposure is there in foreign US stocks. And he's gone through Motilal Oswal 100 Nasdaq and Parag Parikh long term. So now compared to those two schemes, so what is the exposure?
So this is a 100% global product. There is no, so if I compare it to the Parag Parikh product or products like those, which have a combination, like Axis has an Axis Growth Opportunities Fund as well, which has 70% of the portfolio in India and 30% in global stocks. But compared to that, this particular product, the Global Equity Alpha, is a dedicated 100% global product. That's the first point. The second is compared to the Motilal funds. Those funds are 100% US oriented funds. So when you go beyond India into the global markets, the choice is whether you want a product which allocates all over the world wherever the ideas are, or whether you pick a specific geography like the US. What this fund does, and that's where I think which is one of the really strong points of this fund, is that it is a truly global fund. It can find good stocks and invest into good stocks, whether they are in the US, UK, Europe, China, Japan, anywhere. And that's really quite unique. And both these funds don't offer that what this particular product offers.
The next question coming up is from Srinivasa. In terms of returns, how does global fund of fund fare when compared to global ETFs?
So ultimately, it depends on the strategy. Of course, some of the developed markets are more efficient, so the fund managers do struggle to deliver large outperformances the way Indian investors are used to seeing from Indian fund managers. But at the same time, where global fund managers can add a lot of value is in terms of trying to create really genuine bottom-up best ideas portfolio, and that is why we have created this structure where Schroders really tries to scan through the entire 2,000 to 2,500 universe and give us the best, 45, 50 stocks. Schroders' performance track record has been pretty reasonable. They have beaten their benchmark. So to that extent, obviously they've done okay. But at the same time, I think for Indian investors, for now, it's not so much about whether this ETF is right or fund managers is right. It's more about the fact that today, for most of us, we don't really have a meaningful global allocation. So really, as long as we start that journey through the right product structures, that's the most important.
The next question coming up is from a senior citizen. He's asking, I am 73, so at the age of 73, it is safe to invest in these type of funds.
So clearly, I think risk is an important consideration whenever you look at any kind of equity product. But the way I would put it is that it's not about seeing this global products in isolation. Ultimately, what you have to ask yourself is, are you today investing into the Indian equity products or not? If you feel that your risk appetite is appropriate, it allows you to allocate to Indian equities, then there is no reason to not allocate to global equities as well, because that just broadens the universe and creates a better, more robust experience for you. On the other hand, if you're not investing into equities because you're risk averse, like in the case of this investor who's a very senior citizen, then of course I would ask them to be cautious even from global equities, because ultimately all equity markets are volatile. They require reasonably large holding periods, 3-5 years or longer, for investors. So in that sense, yes, you should do it if you have the required holding power and the required risk appetite. But the easy way to test this is, if you think your risk is fine for the Indian equity markets, then part of that allocation can easily go into global. Then there is no difference in that approach in that sense.
The next question coming up is from Anchal. He's asking, would we come to know of the companies, sectors, and markets the actual funds invest in? We're asking, do they have an exposure to access to the fact sheets?
Yes, that's the job that Axis Mutual Fund has to do. So we will provide regular updates on what the fund's investment strategy is and where are they allocated. We will put together fact sheets and updates on the fund. And obviously, when we talk about the fund in India, the fund is nothing but a fund of fund which invests into the Schroder fund. So when we share the details, we will share a lot of the data about the underlying fund as well, including which sectors, which countries, which are the key stocks that they have in their portfolio. So all these updates will be provided in the fact sheets and in through regular updates, marketing updates by Axis.
Next question coming up is from Mr. S. He's asking, being a fund of fund, what will be the cost structure?
SEBI has very tight rules on expense ratios, even for fund of funds. So the combined expense ratio for so basically for a fund of fund, there are two levels of fees. One is what is charged by the underlying fund managed by Schroders, and the second is what is charged by Axis as in the feeder. But from a SEBI perspective, they monitor the total expense ratio between the two put together, and the total expense between the two put together is capped at 2.25%. So in that sense, the total cost of this product is not very different from the typical expense ratio that you find in as when you look at equity products in India. So that's one simple way to look at it is, in the expense ratio is in the same ballpark as regular equity products. If you want the specific number, it is capped at 2.25%. So it is likely to be around or a little below that.
There's some technical question coming up. Do we need to have a separate demat account or a IS account for this, or the normal KYC or MF registration can be there and we can invest in this?
So that's the beauty of this structure, which is that it doesn't require anything different to be done. If you are having an existing mutual fund investment in any fund house, that means your KYC has been completed from a mutual fund perspective. then it's very easy for you to buy units into this fund. It is just like buying any other. I'll repeat. If today you have to buy units of an Indian equity mutual fund or an Indian debt mutual fund or a gold mutual fund, exactly the same process you can follow and buy units of this fund. There is nothing special or extra that you need to do. The KYC requirements are also broadly are exactly the same, which means if you have done it already, if you're already having a folio, there is nothing extra that you need to do. You just can go ahead and buy this units of this fund. That's all.
Okay. Next question is coming up is this a large cap fund or a mid cap fund? And what are the tax implications?
So there are two parts to the question. The first part is that this is predominantly more focused towards the really large, good quality companies which are really growing well. So typically you will see that the type of names which are there, and I gave the examples like, so Amazon or Google or Nestle or Adidas or BMW. So these are all very large companies. So typically what you'll find is more of large cap ideas in the fund, but it's not restricted. It can get into good mid caps as well. But predominantly we've seen large caps. That's the first part. The second part on the taxation, as I explained earlier as well, in any products that are basically totally allocating money to global equities, from an Indian tax perspective, they get tagged as debt mutual funds. So you have to hold for 3 years, beyond 3 years for getting long-term capital gains benefits.
We'll just take the last three questions. The next question coming up is markets are at all-time high. Is it the right time to start investing now?
So there is no right or wrong time. Remember that markets always will keep going through ups and downs. And as investors, the only way we can avoid getting, paralyzed by constantly worrying about market falls and market ups and downs is by being disciplined, making regular investments in the market, and having a good long-term horizon. And the same rules will apply for global investing. Same rules will apply for Indian investing. So be disciplined, be regular, don't try to time the markets, don't worry about a little bit of ups and downs. In the long term, if companies deliver growth, then the direction of the market is that it should go up steadily over a period of time, because the companies that you invest into are growing their earnings over a period of time. So if that is the underlying logic, then obviously the market, if it's going up, it will seem as if it has gone up. So will it fall? And also markets go through ups and downs. We all know that. So I would say don't try to get too perturbed by the noise level around the markets. Just be disciplined. So if you have a long-term horizon, if you're making regular investments, then you don't have much to worry about.
The next question coming up is a track record for Schroders for the last 10 years.
So Schroders, especially this particular fund, has been in existence for the last 15 years, and the track record has been pretty robust. They have been able to be around the benchmark, and in fact, the last 5 years they've comfortably been ahead of their benchmark. So the performance track record is quite good. Broadly speaking, when you look at it in a rupee terms, the fund has returned anywhere between 10 to 12% per annum over the last 15 years, maybe a bit higher in the last 5 years. So it's been a reasonable performer both in absolute terms as well as when you compare it to uh, uh, its peers or benchmark in the global context.
Just take the last question. Is it an active fund or a passive fund?
It's very much an actively managed fund. As I explained earlier, you are scouting the entire world, more than 2,500, and trying to identify the best 45, 50 stocks to invest in. So that's the highest form of active management, because you're literally taking a view and only the very, very best stocks that get passed through the filter, and that you feel are offering the best potential, pass through that filter and are able to form part of or are allocated to from a portfolio perspective. So it's very much an actively managed product.
That's it. We end our question and answer session over here. Thanks, customers,
Great.
and thanks, Ashwin, for taking us to this theme. The idea of global investing, global businesses. Thank you very much. Thank you all.
Great.
Thank
Thank
you,
you so
Ashwin.
much. Thank you. Thanks everyone for your participation. Okay. Goodbye.